Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Brian Stutland, managing partner at Equity Armor Investments, as well as Anthony DeMartino, co-founder and CEO of Sentora. We're here to discuss the impact of escalating U.S. debt on traditional assets as well as crypto. It is great to have the both of you with us. Welcome to Trade Talks. And Brian, it's interesting, if you look at year-to-date performance in the S&P as an example, we're relatively flat on the year, right? But if you dissect it and what's happened in between, there really has been quite an impact to what's happened in the equity space.
Yeah, really. I mean, I would describe it in three words: crazy, abnormal, volatility, right? I mean, the amount of volatility we've seen in the marketplace has been enormous this year in 2025. Almost so much where we haven't really seen this before in the past. Even include COVID, include the dot-com bubble and whatever, the back and forth movement's been tremendous, and it's all been news driven. Whereas before, maybe in the past, there were credit concerns that were driving this sort of crisis. Right now, it's news driven, how the economy is going to look, what tariffs are going to have that kind of impact on the economy. So that's driving a ton of volatility, and you really have to be nimble, almost have some cash set aside to be able to put to work when you find some dips where you want to jump in and be willing to let it go when you've seen some rips.
Yeah, and Anthony, I want to bring into the conversation here as it relates to Doge, not the coin, of course, but the efficiency program that was put into place since inception, and really, I think what voters were voting on was to rein in government spend, to make it more efficient, not necessarily to add another $3 trillion to the deficit. So when you think about it from the broader economic trends, the impact of fiscal policy, and how the digital asset market is perceiving this, what are your thoughts?
I think it's a great question. I think you have to split the political from the economic. I think it's a big economic win for the Trump camp to make it sound like we're cutting spending. Howard Lutnick is trying to increase income by $1 trillion, and Elon was supposed to try to cut it by $1 trillion. I think the reality is it'll lead to regional job losses. I think the government spending on employment will go down materially. And I don't know if that's going to address the problem with our overspending. So from a crypto standpoint, I think this can benefit in two ways. One, if we get increased job losses to the point where unemployment goes up high enough, that will be seen as rate cuts coming, and that's a very fuels a speculative fire. So I think that's and if inflation comes on the other side, it fuels the kind of Bitcoin drive for inflation hedging.
Yeah, and Brian, I want to take one of Anthony's points and come back to the broader economic conversation here. Over the past couple of weeks, we've seen a number of travel resources saying that there's an expectation of a decline, not just in the New York City area, but to the U.S. overall, not because of lack of demand or allocating resources elsewhere, but the perception of instability with the U.S. government and just traveling to the U.S. When you think about how employment has been incredible support for the economy overall, guess what's a big part of the pie? The services sector. And that's concerning, especially if the outlook is a little bit murky. Just even a small segment such as that, well, actually tourism's not a small segment, but when they're experiencing a decline, I believe it was 22.5% since peak. That's a big number. We saw what happened to the services sector when COVID hit.
Well, yeah, I mean, certainly, let's just maybe even take a look at what the VIX is telling us, because in some ways it actually, what you're talking about basically is sort of this recessionary kind of effect, right? And when you look at the VIX, typically historically, it trades somewhere in the upper teens on average. But what we've seen really over the last, call it 6 months, 9 months, is the VIX staying above that 1720 level, and it's in this territory where people expect more volatility in recessionary kind of terms. So yes, I mentioned before earlier in the show that a lot of it's been news driven, that's moving the markets back and forth, up and down. But really, there's a little bit of an underpinning tone here that says, wait a minute, maybe we're getting some recessionary effects. Is GDP really going to hang in there? And the VIX and volatility is really telling us that it's trading in the higher region that we typically see during recessions. So that's something to sort of keep an eye on, that things are getting bubbly, frothy here. And something, you mentioned here, the services sector declining, that could lead to that snowball effect. And then Anthony said, the Fed's going to need to step in and cut if they're sort of going to be able to buoy this and sort of hang in there.
Yeah, and Brian, I want to go back to the, oh, I'm sorry, go ahead, Anthony.
Yeah, I was going to say, if you had another chart that we could have done in advance, but if you look at the CDX for investment grade corporates, we saw the blowout spike towards the all-time highs, but it is not nearly recovered as much. So there's still indications that liquidity is tight, especially in investment grade corporates, which is still at probably 2 or 3 standard deviations from norm, while the VIX has come all the way back.
Mm. Um, All right, actually, Brian, I want to follow on to Anthony's point there. So when you think about the escalating debt, the amount of uncertainty that's out there, and the market's always going to climb some wall of worry. This seems to be a little bit more self-inflicted wounds, and execution can really help us move beyond it. But when you think about it, crypto perhaps as a safe haven with, it's not as tied as much to what's happening with inflation. Perhaps even could be considered a safe haven, certainly for emerging markets. That's been, one of the catalysts as it relates to stablecoin adoption. Anthony and I are going to get to that in a moment here. But do you think this could potentially drive more assets to crypto? I mean, the alternative investment demand was high into 2025 as it was. Is this another catalyst for it?
Well, I think there's a couple things going on with that. I mean, Anthony earlier in the show mentioned the other flip side to it is, are we going to have inflation? And that's been one thing, certainly that's driven gold and how well that's done. But there is some correlation of gold and another asset class, so to speak, currency, let's call it, in this case, digital gold, Bitcoin, which is kind of correlated and trended to that. Now, there is some, I think, underpinning effect to Bitcoin that has more beyond just the digital gold, the anti-fiat currency, which is really about, let's call it sort of the technology wave of transactional digital payments becoming more and more popular towards sort of this movement, of course, away from government, all the government spending that we've talked about, driving all this and escalating it. And you look at a chart, and let's just look at Bitcoin here, for example, obviously the most popular one to own by everybody, is this trend has been to the upside. As sort of we saw AI expansion, technology growth sort of kick in as of recent, there's been a direct correlation between Bitcoin and the expansion of artificial intelligence, which is going to use electricity. Bitcoin uses electricity in order to sort of mine. So there's some correlation there. So you get this sort of AI correlated play there. You get a anti-fiat currency play on there. And that trend has been to the upside. In terms of what that looks like going forward, I would probably be an owner of this somewhere in there. And any sort of back off below 100,000 on Bitcoin, I would be a buyer.
Yeah, and Anthony, I want to talk about the practical use cases of digital assets overall, right? We just came back from Consensus. There's been a number of conferences going on in the digital asset space. Certainly, we've heard the administration talk about it, and this seems to be the way forward as the global capital markets evolve in a very digitized way. So I think this is something that's going to continue to gain traction, whether you're thinking about how the liquidity profiles are going to look over the next 5 to 10 years, the real world applications, the fact that billions of people around the world are using the underlying infrastructure to grow local microeconomies and cross-border payments and as inflation hedges to their local currencies. This is something, the underlying infrastructure is something that's happening outside of the news noise that we hear.
Yeah, I think we, as Americans, sit in a very privileged position to own a currency that essentially the inflation rate has been, except for the 70s, transitory. But at the end of the day, if we're feeling inflation for commodities, goods, services, the rest of the world is feeling it worse. I think when you think about Bitcoin as a correlated risk asset, I think gold, if I think about gold and Bitcoin, I think gold, there have definitely been periods where gold has not been a great correlated hedge or anti-correlated hedge to inflation, but over time, as you smooth out, it gets there. I think one thing to keep in mind about Bitcoin and its correlation is that we're going through an accumulation phase. It wasn't that long ago, I think it was 2010, where gold ETFs started to take off and gold outperformed because it became available to a new user base. I think with Bitcoin ETFs and all the advancements there, and then these leveraged kind of acquisition companies that have been announced recently, I think Bitcoin can continue to outperform even its inflation correlation because we're accessing new markets through different vehicles.
Yeah.
So that's the Bitcoin side for sure.
Right. But then I want you to address the stablecoin side as well, because that is where the real world application, and to your point, we take a very US Western centric view when it comes to digital assets, or we traditionally have, where what's the value? What's the hedge? How do I trade it? What's the strategy? It's the infrastructure underneath that is driving global capital markets as a whole, and stablecoins. And when you start thinking about tokenization and the applications of that, that's really where I think the story is.
Yes, I think that's great. I want to go back to a prior comment you had made about the service sectors and travel, which stablecoins allow you to do. And if the government becomes more aggressive around foreign ownership of dollars, as we all know, 86% of trades in dollars, 50% of the dollars are held offshore or more. Um, Getting access to dollar bank accounts for people in emerging markets is essential to store any type of wealth or pass along any wealth. You know, I used to run emerging markets for Latin America, and in places like Argentina, houses really only trade in dollars, and they've been in capital control since 2019. So I think the idea of stable coins to get access to dollar for people who are not wealthy enough to have Swiss bank accounts is a big innovation, but also the ability to self-sovereign your dollars. So if you live in a country that the government U.S. decides to get aggressively sanctioned, they're going to freeze your dollar bank accounts. If you own dollar stable coins, they don't have that kind of control. So I think that's another aspect that gets under mentioned when it talks about the importance of this technology.
Right. And of course, in the absence of legacy banking systems, you also get access to cross-border payments and ways to get alternative financing, which I think is fascinating. To your point, you know, you having experience in Latin America, I covered African markets for years. And this is something that, you know, I bring my own coverage back to because I've seen how these types of technologies have helped local micro economies grow, especially for women getting access to financing and so forth. Brian, next
Can I
time.
make a quick point on
Yeah,
Africa? I
yeah.
think it's really interesting. So in global foreign exchange, especially in emerging markets, there's very few FX pairs between two countries. Most FX pairs are with the dollar. So if you want to go from Nigeria to Ghana, you're trading through the dollar. There's no Nigeria-Ghana swap. Bitcoin has become that intermediary currency in Africa, where the trading that's happening because there's very little cross-border trade in Africa because of the lack of foreign exchange conversion, and Bitcoin is stepping into that spot.
That's an excellent point. Thank you for that. Brian, next time we speak, we're going to be in June, wrapping up the second quarter, wrapping up the first half of 2025. So as you think about summer trade, going into the back half of the year, going into the beginning of the third quarter, do you expect the same type of environment that we're in now?
Yeah, I do. I think until we get better GDP numbers coming through, better unemployment, or at least clarity that unemployment rates are going to stabilize, until we get some clarity, especially on tariffs. I mean, just the lack of clarity for corporate America right now on how to behave and where to manufacture. Obviously, the point is bring your manufacturing back to the U.S. So that'll help stabilize and help you figure out how you need to spend in order to resell your goods. But until we get that clarity, I think coming up in July, we've had this trade deadline that Trump sort of postponed for negotiations for other countries to come to the table. We're going to get that deadline come to fruition. So there will be continually updated news on where tariffs are going. That will continue to drive volatility in this marketplace. And so you've got, like I said before, I think it's got to be a very nimble, nimble positioning in the market. Have cash set aside for times when you can jump in and be willing to get back out when you can.
Yeah. Yeah, and that's a great point that you bring up, Brian, because now we have the constitutional aspect that's part of the tariff conversation, which adds another layer of complexity and uncertainty. Anthony, to wrap up with you, when you think about it from the retail perspective, I would imagine that diversification is something that you are certainly advocating for. When you think about, adding some capital to a digital asset piece within the portfolio, what are your recommendations for investors?
I think I look at crypto as a $3.5 trillion asset class, but in reality, it's 3 or 4 tokens. It's Bitcoin, which is 2.2 trillion, which is the majority. It's stable coins, and then you have Ethereum, Solana, and Ripple, right? So to me, the institutional and what the investor base should look at is those 5 tokens. Listen, I'm not an economist, but there's been multiple economic reports written about how Bitcoin diversifies any portfolio. It's non-correlated returns. It's potentially used as inflation hedging. And I think, honestly, at this point in time where there's so many acquisition vehicles and structured products that give retail an easier ownership over Bitcoin, I think not having it as part of your portfolio is a mistake.
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.